So the M&G Absolute Return Bond Fund is one of our more flexible bond funds in the range. So we can go from negative duration to positive duration, or we can even take negative sensitivity to changes in credit spreads. So it really is our most flexible bond fund across government bonds, corporate bonds, and we also take currency views as well. So the portfolio is divided essentially into three main buckets. We have about a third of the portfolio invested in primarily defensive credits. These are usually short-dated, investment-grade corporate bonds or mortgage-backed securities or senior secured high-yield bonds. And this part of the portfolio aims to generate a consistent total return or a consistent income. In addition to that, the rest of the portfolio is invested in what we call opportunistic credit, which are the main opportunities that we see anywhere in the corporate bond markets. And what we do is we try to take advantage of those opportunities, and then usually we reduce the systematic risk that we have in the fund with a derivative overlay. The aim is to add more credit alpha and to have less credit beta. And again, in addition to that, we'll overlay also our duration and our currency views. The volatility of the fund historically has been quite low. So the fund was launched in December 2016 and with a strict volatility target. So we always aim to keep volatility below 5% on an annualized basis. So it's quite a robust risk management process, and historically volatility has been around 1.5% for the fund, so also quite low. In terms of performance, the fund was only launched just about over a year ago. 2017 was a very good year for the fund. 2018 has been a little bit more challenging in terms of market environment, but since launch the fund is still up just below 2% after having been launched just over a year ago. Yes, definitely. So we do think that the starting point for fixed income today is maybe a bit more challenging. So if you invested in fixed income maybe passively 10 years ago, you might have had a yield of 4% and a duration of around 5 years. Maybe that was the risk-reward trade-off that you had 10 or 20 years ago. Today yields are much lower, and the duration of major investment-grade corporate bond indices has increased quite significantly. So your risk-reward trade-off is a bit more challenging, especially in a world where monetary policy is going to become tighter and where yields are expected to rise. We think having a very flexible approach to investing in fixed income, trying to generate more alpha from fixed income, is really the way forward for our investors.